for International Economics. I'm Nicolas Véron. It's my pleasure to welcome here Frank Elderson to speak about climate change, accounting for climate change within central bank and banking supervision mandates. Frank Elderson, of course, is a member of the executive board of the European Central Bank in Frankfurt and the vice chair of the European Central Bank Supervisory Board. This is the first of two observations I want to make, because this is the only position in the ECB that completely straddles the European Central Bank's two mandates. The main mandate of monetary policy in the main building, the taller tower, with your colleagues at the executive board, chaired by Christine Lagarde, but also as a vice chair of the supervisory board in the smaller tower, in charge of European banking supervision as the hub of the network, which is also called the single supervisory mechanism. And therefore, Frank Elderson is uniquely positioned to talk about the way climate change considerations intersect with not just one, but both mandates of the European Central Bank. Well, of course, the ECB has a single mandate, which is price stability, but central bank observers know what I'm referring to. The second point I want to make in introduction is that Frank Elderson is, if not the leader in the global central banking community on these matters of climate change, and I think that's an important observation given the speech he will give us. Frank has been a central banker since 1999 for more than 2 decades at the Dutch Central Bank, the Nederlandse Bank, which I probably mispronounce, and since late 2020 at the European Central Bank. But he's also, and importantly for us today, been a pioneer in taking into consideration sustainable objectives, the fight against climate change, the fight against global warming. In 2016, he became the chair of the Sustainable Finance Platform at the Dutch Central Bank, and then he was instrumental in the creation of the Network for Greening the Financial System, the NGFS, which is kind of the first effort of the global central banking community to integrate those concerns into a central banker's job, and became the first chair of the NGFS in 2018, was reappointed in 2020. So he really has been a path breaker in those matters. He's also been, since 2020, co-chair of the task force on climate-related financial risks at the Basel Committee on Banking Supervision. With that, Frank, over to you.
Well, thanks a lot, Nicolas, for your very kind introduction and words. Good morning to all of you here. And I'm acutely aware that last week was the week that so many things have been said, that I'm pretty sure also this room still echoes many thoughts. So it's quite a daunting thing to add some words on my part, but I'm going to be doing so anyway. Central banks and supervisors are not climate and environmental policy makers. Central banks and supervisors are climate and environmental policy takers. There are a lot of climate-related and environmental factors to take into account to deliver on the mandated objectives of central banks and supervisors. This is not a message that just comes from me. In fact, there is a global consensus among central banks and supervisors, as established through the Network for Greening the Financial System that you just so kindly mentioned already, Nicolas, which has presently 121 members worldwide, including 6 authorities here in the United States. It is acknowledged in the work programs of global setting bodies, such as the International Sustainability Standards Board, the Financial Stability Board, and the Basel Committee on Banking Supervision. And this global consensus is reflected in the actions taken by central banks and supervisors in the pursuit of their respective mandates. And today, I will explain why I will explain why central banks and supervisors taking climate-related and environmental considerations into account should not be seen as controversial. I will outline how the actions that central banks and supervisors take to account for climate-related and environmental factors follow from their democratically assigned mandates. And I will show how these actions build on the awareness that the economy will be subject to increased shocks from ongoing climate and environmental crises, while undergoing one of the biggest structural transformations in modern history. And I will show that these developments, without any doubt, will have a material impact on the financial sector too. The many examples of climate-related and environmental risks, when talking about this topic last month, because there are many of those, when talking about this topic last month, let me just cite the US Secretary of the Treasury, Janet Yellen. She was very clear when she said that such impacts are no longer hypothetical. And there are many examples on both sides of the Atlantic. Intensifying storms along the coast of the United States, severe floods and droughts across continental Europe, and wildfires in California, Florida, Italy, Spain, you name it. Both extreme rainfall and extreme droughts are on the rise in places where we live and work because they are on the rise around the globe. It is estimated that in the United States, the 5-year average annual cost of billion-dollar climate-related disasters, including 2022, is now at $119 billion, which is triple the long-term average. At the same time, governments are taking action to mitigate and adapt to the consequences of the ongoing climate and environmental crises. In the United States, the Inflation Reduction Act contains unprecedented measures aimed at supporting the green transition. And similarly, in the European Union, a multitude of policy, regulatory, and legislative measures, including the European climate law, are being implemented. To reduce the net green gas emissions by at least 55% compared with 1990 levels by 2030, and to ensure climate neutrality by 2050 at the latest. Measures at the EU level are being complemented by actions in individual member states, while action is also being taken on the individual state level here in the United States. Now, not only public authorities and non-governmental organizations acknowledge these physical and transition risks of the climate and environmental crises for the financial sector. Banks themselves also tell us that they see these risks as material to their risk profiles in the near term. Put simply, climate-related and environmental risks cannot be ignored. And fortunately, they are no longer being ignored. Quite to the contrary, they are being taken very seriously. Please, let me now turn to how climate-related and environmental factors are increasingly being taken into account in banking supervision. It's worth recalling the guiding principle for prudential regulators and supervisors around the globe. Guiding principle being that no material risks should be left unaddressed. And this pole star, if you like, this pole star of banking supervision is enshrined in the core principles of the Basel Committee on Banking Supervision and has been included in legal requirements for decades. According to this simple but crucial principle, banks must identify and adequately manage the risks that they are exposed to. And this also holds true for climate-related and environmental risks. To be clear, it is not for supervisors to tell banks how green their lending policies must be. Supervisors are not pickers of winners and losers in the green transition. However, the international community of banking supervisors does insist that ignoring the ongoing climate and environmental crises, as well as the transition towards a more sustainable economy, is no longer compatible with sound risk management. At the European Central Bank, we published our guide with supervisory expectations for banks' risk management practices of climate-related and environmental risks in 2020. In the 2 years that followed, we conducted a number of supervisory exercises focusing on banks' approaches to managing these risks. We looked closely at how banks are performing relative to our expectations and found that they still have a long way to go before they are fully compliant. For example, most banks have put in place an organizational architecture to address climate-related risks in line with our expectations, but banks' approaches still lack sophistication and granular information that are required for active management of the risk profile of institutions. Based on our dialogue with banks, we think it is reasonable to expect the gap between their current practices and full compliance with our expectations to be closed by 2024 at the latest. Consequently, we have announced that we will hold the banks to this date, including a number of interim milestones. And if necessary, we have also highlighted that we will enforce these timelines. Now, in the United States, the Office of the Comptroller of the Currency, the Federal Deposit Insurance Corporation, and the Federal Reserve Board proposed substantially similar guidance for large banks under their jurisdiction. And this year, the Federal Reserve Board will complement this guidance with an exercise focusing on banks' resilience to a set of different scenarios for the climate crisis. Supervisory authorities on both sides of the Atlantic are taking action to ensure that climate risks are appropriately assessed and accounted for by banks in their risk management practices. However, it is not just a transatlantic trend. Thanks to the Basel Committee's Task Force on Climate-Related Financial Risks, which I co-chair with Kevin Styro of the US Federal Reserve, concrete steps have been taken to merge existing international practices into an initial formal consensus at a global level. And as a result, there is progress in all three pillars of the Basel framework for the global prudential regulation of banks. For instance, as a first step on Pillar 1, the Basel Committee has recently published a set of frequently asked questions to clarify how climate-related financial risks may be captured in the existing Pillar 1 framework. The Basel guidance tells banks how they can already consider material climate-related risks in their regulatory capital, for example, when determining the value of real estate. Moreover, in June 2022, the Basel Committee published the Pillar 2 principles for the effective management and supervision of climate-related financial risks, making clear its expectation that these principles should be implemented as soon as possible. And to ensure this, the Basel Committee included the monitoring of progress across jurisdictions as a key element in its 2023-2024 work program. In the field of disclosures, I'm similarly pleased to see various international initiatives brought together at the Basel level. Building on the extensive work that has already been done in various fora, the Basel Committee started developing high-quality and globally consistent Pillar 3 climate-related disclosure requirements. And the Basel Committee will issue a consultation paper on the proposed framework before the end of this year. All of these steps foster transparency, ensure an international level playing field, and maintain the risk-based orientation of the Basel framework. And I welcome in particular the fact that we are making progress across all key elements of the Basel framework. Such a holistic approach, as we call it, is the only way to make sure that climate-related and environmental risks are managed competently, consistently, and comprehensively, which is just how regulators and supervisors and banks are used to handle any other risks since time immemorial. Only then can banks preserve the solidity of their balance sheets and continue to serve their stakeholders irrespective of the macroprudential challenges that may emerge. So let me now move to that other leg of the central bank's mandates, which is monetary policy. Obviously, central banks can only pursue price stability if they can understand, assess, and forecast how economic shocks and trends affect inflation and the effectiveness of monetary policy. So, apart from its scope and potential severity, accounting for the climate and environmental crises is no different than accounting for globalization, demographics, or financial innovation. Central banks must adapt their data and economic modeling to be able to assess the monetary policy implications of climate change and environmental degradation, including transition policies. Moreover, central banks must take into account their exposures to climate-related and environmental risks when designing monetary policy instruments and considering the composition of their balance sheets. We know that the preservation of price stability sometimes requires a central bank to take risks onto its balance sheet. For example, when engaging in quantitative easing, central banks absorbed duration risk by purchasing long-term bonds from the private sector. They did so not because they had identified some kind of a lucrative investment strategy. In fact, central banks were very much aware at the time that their profitability would be impacted if interest rates were to rise in the future. Instead, the absorption of duration risk was crucial to providing monetary policy accommodation beyond what could be achieved by lowering policy rates to support inflation that was, at the time, as we all remember, too low for too long. To enable central banks to continue to effectively use their balance sheets in the pursuit of their mandate in the future, it is important that the soundness of their balance sheets is preserved. And this means that central banks must be very conscious of the risks that they need to take to preserve price stability. And at the same time, central banks must be equally conscious of the need to steer clear of risks that do not contribute to, or may even be detrimental to, achieving price stability. Now, all that having been said, I'm not aware of any evidence suggesting that misalignment between the central bank's balance sheet and a transition path compatible with the Paris Agreement might be helpful to securing price stability. On the contrary, available evidence points in quite the opposite direction. Aligning ourselves with the status quo, which is biased against Paris compatibility, risks adding to macroeconomic volatility, which would complicate the conduct of monetary policy in pursuit of price stability down the road. And as a result, central banks taking climate-related and environmental financial risks into account supports price stability in two ways. First, it contributes to preserving the soundness of central banks' balance sheets. And second, it reduces bias towards emission-intensive activities that can fuel macroeconomic volatility in the longer term. In the case of the European Central Bank, in addition to contributing to our primary objective of price stability, our climate and environmental actions also serve our secondary objective. Let me say a word on that. This secondary objective, just like our primary objective laid down in the EU treaties, tells us that we shall support the general economic policies of the European Union, without prejudice to price stability. And to put this in slightly less legalistic terms and more pragmatic terms, if you like, whenever we have a choice between two instruments or between various calibrations of an instrument that are equally conducive to price stability, we choose the one that is most supportive of the EU's general economic policies, including the climate neutrality objectives. And let me give you a very specific example of how we at the European Central Bank put all this into practice. In October 2022, we started tilting our reinvestments of corporate bonds towards issuers with a better climate performance. And you may also be aware that since March of this year, we have been reinvesting only part of the maturing bonds to ensure the consistency of our monetary policy portfolios with the overall monetary policy stance. And to maintain a decarbonization path for our corporate asset holdings that is compatible with the Paris Agreement, we decided to increase the degree of our tilt towards issuers with a better climate performance during partial reinvestment. And this serves to avoid undue exposures to climate-related risks that are detrimental to price stability and to align the way we administer our monetary policy more closely with the general economic policies of the EU. Very similar reasoning could be applied to our public sector bond holdings, which amount for most of our monetary policy assets. At the moment, the bulk of our public sector bond holdings consists of bonds issued by governments of EU member states. However, the climate and environmental risk intensity of these different bonds is not obvious in the absence of a clear and reliable framework to assess their compatibility with the Paris Agreement. At the same time, since the pandemic, the universe of supranational bonds issued by EU institutions has increased significantly, with a relatively large proportion of green bonds. And when there is no clear monetary policy rationale for preferring domestic sovereign bonds, in my view, we could consider increasing the share of EU supranational bonds in our total bond holdings to avoid potential climate and environmental risks and better align our balance sheet with the general economic policies of the EU. Our commitment to avoid climate-related risks that are detrimental to price stability and to align with the general economic policies of the EU is part of our monetary policy strategy. And therefore, it applies to everything that we do. Beyond our bond holdings, this includes our collateral framework. To support our efforts to align with a Paris-compatible transition path, we have recently started disclosing our exposures to climate-related financial risks. And we will regularly review our measures to ensure that we are fit for purpose, that they are fit for purpose, I should say, our measures, and aligned with the objectives of the Paris Agreement and the EU's climate neutrality objectives. Now let me conclude. If the macro-financial developments of the past year have taught us anything, it is to remember the importance of having dedicated institutions responsible for maintaining price stability and the soundness of our financial system. As central banks and supervisors, this is our job. We are not climate and our environmental policy makers. We are climate and environmental policy takers. And we need to take climate and environmental factors into account if we want to deliver on the important supervisory and monetary policy mandates that we have been given. By failing to do so, we would be failing our mandates. And believe me, we won't. Thank you for your attention.
So thank you very much. This was a powerful statement of priorities, and I was very struck by the fact that you denied any responsibility for environmental policymaking in line, as you explained, with your mandate. I took your speech as being calibrated to be a speech that any central banker or banking supervisor could agree on. So my first question would be, how far advanced are we in that direction? When you look at your global peers, and here I'm not talking only about, actually I'm also talking about people in this country, policymakers in this country, but also in what in the geopolitical conversation is increasingly referred to as the global south. How far would you say they are along the lines that would lead them, and of course I encourage you to go into individual examples, to give the same speech as you just gave?
Right. Well, thank you very much again for having me here, but also for this first question, because I actually think that you summarized, one of my main messages perfectly well. I think that we are at a stage now in 2023, and as you said in your introduction, I've been around a little bit in this field for the last decade or so. I think truly that there is now a global consensus that the question is no longer does the effects of climate and environmental change fall within the mandates of supervisors and central banks, and aren't they doing too much to actually now the consensus being, yes, it does fall within our mandate, and by not looking at it, by not understanding how this affects all that we do, you would actually be failing your mandate. Now, I think, the focusing on supervision first, the very fact that the Basel Committee came out with these principles last year, I mean, it's easily said the Basel Committee, but the Basel Committee is the global banking supervisory community, isn't it? Practically everyone, and don't forget that also those who are not at the table follow this in their jurisdictions to a large extent. And I think that is to a certain extent, a tribute to the prep work that was done in this NGFS that you referred to earlier, where central banks and supervisors in a setting that was not a formal standard setting body, that's where the intellectual work was done in the beginning, where the mindset change actually took place, where the understanding really landed that climate-related risks via physical risk channel, via the transition risk channel, translate into financial risk, and therefore are in the mandate of central banks and supervisors. That understanding landed there, has now landed in the Basel Committee. We're not just talking, but we are acting. There are these principles. There are the frequently asked questions. There is this work, and that will be published later this year on Pillar 3. So there are real actions. And then on the monetary policy side, understanding that you cannot, all the forecasts that underlie our monetary policy deliberations, and this is true for all central banks in the world. The macroeconomic modeling that we use, if we failed to take into account these transformative transformations that we are seeing today, we wouldn't be doing our job well. And I think that is accepted.
So let me drill down to individual countries, and starting with the one we're in right now, the United States of America. As everybody knows, climate issues have become a bit of a political football, including in the financial sector. How would you describe the, how do you look at the debate in the US, the political and policy debate on these issues? And do you think the politics of the US make it possible for the Fed and the banking supervisors to adopt the kind of perspectives that you exposed in your speech?
Yeah, of course I'm aware of political debates, but I hope that, readers of my speech listening here in the audience, this is not a political speech, this is a technical speech. So from whatever angle you look at the world in political terms, you would want banks to be able to play their role in the economy. You would want banks to be resilient. You want central banks to deliver on their price stability mandates. The physical risks that are manifestations of this climate change that we are seeing, the droughts, the Colorado River Basin problems that we see, the wildfires, the floods, that's not political events. These are real events that take place and that produce real losses that need to be borne somewhere. So taking that into account is just sound exercise of our supervisory and also monetary policy mandate. I think this is something that is clear. I think it has landed so much yet now in the in the global thinking that I don't think that any central bank that would be unable to pursue their mandate by doing so, whatever politicians say.
Is that also true of banking supervisors? Obviously, there have been recent developments in the US that have kind of cast a cloud on banking supervisory effectiveness and the way it's looked at recently. I know you're not going to comment on that because supervisors don't comment on other supervisors, but do you sense more difficulty to take this purely technical, facts-based approach among supervisors that are not protected by an independent central banking mandate?
I think that supervisors are protected by their mandate because we have to make sure that banks manage all their material risks. And as I said before, that is something that has been, part and parcel of our legal mandates, of our, the way that our mandates have been understood since forever. So the new, and actually no longer so new, but insight is that climate-related risks translate into financial risks that need to be managed. And banks are doing this. Actually, now in New York, the Task Force on Climate-Related Risks, we came together earlier this week, and there was a reach out with the banking system. All these banks, they are managing these risks. They know that it is important to know where the exposures that they have on real estate, where that real estate is located. They know that it makes a difference whether certain buildings are energy efficient or not, and therefore still carry the weight of upcoming refurbishment costs that need to be there. They know by zip code where these, it makes a difference in Miami on which side of the street, in certain streets, some real estate is located or not. So banks are increasingly very sophisticated doing this. So if the banking system is doing it itself, they don't do this because of some kind of hobby. They do this because they know there is real money to be lost and made, by the way. This is also something that I would like to highlight. We should not forget that the whole transition that we are talking about, all the trillions that need to be invested in the decades to come, there are as many opportunities, and those are being taken also in this jurisdiction as we speak, stimulated greatly, of course, by the Inflation Reduction Act.
So you mentioned in your speech both sides of the mandate, monetary policy, price stability, and banking supervision. Let me take them again in that order. I mean, you take the other order in your speech, but let me take them in that order, starting with monetary policy. You've been a central banker in several different cycles, and we had a deflationary cycle during the 2010s, and now we're in an inflationary cycle, or at least a cycle of rate increases, certainly at the ECB as with other central banks. How would you characterize the way these cycles of low rates or high rising rates play out in terms of the climate mandate, and how do you see the interactions there?
Right. Well, maybe, I would say, again, we are here, there's actually two pole stars. There's the pole star I referred to in the banking supervision. Here, of course, is price stability. We are pursuing doggedly our price stability mandate. That's what we do. The example I gave in my speech, I think, was meant to show what that means in the current cycle. We are no longer actively, net purchasing assets. Obviously, we are in a phase of partial reinvestments. In that phase, we have decided, in line with the arguments that I gave, to tilt and to now actually, since it's only partial reinvestment, to actually tilt additionally to make sure that we are on this path. Now, at one point, we might stop these partial reinvestments. So we will have to then to think what we do. That is a decision we have not yet taken. So it's not for me now to make any predictions. But we will have to think about what it then means in terms of the commitment that we have made in terms of the Paris compatibility of our asset holdings.
On banking supervision, and that will be my last question before opening it to the floor. So I encourage participants to get close to the microphone if you want to ask a question. What you mentioned, the fact that banks are increasingly granular and sophisticated in the ways they look for climate-related risks. There's been a huge debate about standard setting and measurement for this kind of monitoring and disclosures for the banks under your supervision, but also you alluded to this for the ECB itself in the way it reports on its balance sheet and looks at it from a climate-related perspective. Can you tell us a bit more about your perspective on the state of maturity that has been achieved or not yet in terms of measurement standards, harmonization, getting to a common comparable way of looking at all those things? I mean, it's in the title of your speech that we should account for climate change. So can you expand on the accounting for all this?
Yeah, sure. Very good question. I think here a lot of progress has been made, but we are also in the midst of much more progress yet. So some years from now, looking back, we will think this was a very important year. The International Sustainability Standard Board, the ISSB, they will come out with their the S1, as they call it, and S2 standard. I think still in June. The Basel Committee is working on the Pillar 3. There is various pieces of legislation in the EU. So that is to say that yes, there's a lot of movement, but all these things that need to be implemented, banks will have a little bit of time in phasing in, etc. So there is still some time to go on the one hand, but this is coming and it's formal and it's going to be applied across the board. So there is real progress just around the corner, I would say. In the meantime, banks are able to disclose. Actually, today, the ECB, we published our third annual report on disclosure by banks. So a little bit, front loading, if you like, upcoming legislation in the EU. We have been, going through various years already of interactions with the banks to make sure that they were, as ready as possible once the formal legislation enters into force. And here we see clear progress. there's, I think now 86% of the banks that actually do recognize that their exposures to climate-related risks is immaterial, which was I think less than 35% only 2 years ago. So there's a huge step there, but it's not yet granular enough. It's not yet so there's progress, but what we try to do on many of these things, also more generally in terms of our supervisory principles, is to not just carry a stick, because you might have heard that I said, we have set these deadlines, and if necessary, we will enforce these, but also use carrots, if you like, by publishing good practices. So we look, at all the banks, we see what is being done, also in terms of disclosure, and there are banks that are, more progressed than others, more advanced than others in terms of engagement with their clients, of using real life data. There's others that have a clear pathway in saying, okay, we don't have all the data that we need from our clients, but we are using proxies, but we already now know when we were going to substitute these proxies for real data, et cetera. So whenever we see good practices, we publish those in order to help the bank so that everyone can move forward as soon as possible.
So again, pending questions from the floor, I encourage you. Can you give us more concrete examples of this? I mean, what are the kind of data that you expect the banks to disclose? You referred to best practices. What is the kind of mainstay of climate-related disclosures, and what you expect the banks to provide to investors and the public at a more down-to-earth level?
Right. Well, to give you just one very specific example, I see somebody wants to ask questions, so I'll be short, but is that, in Europe at least, banks should know the energy efficiency certificate of the real estate that they are exposed to. And there, we have seen progress, but it's not 100% yet. So not 100% of the banks under our supervision know of all the real estate that they are exposed to, what the energy label is. Now, there are not trillions of pieces of real estate, so this is something that can be done and should be done. But this is the other part of the question. Some of this is also, internal governance issues. So this needs to be organized in terms of governance. It needs to be organized in terms of IT systems. It needs to be organized in terms of the first, second, and third line of defense. So lots of things that banks know how to do and that they've done forever in many other subject matters. But here, this is ongoing homework. But the energy efficiency is a clear example of the things that we would like to see.
Peterson Institute. I'd like to ask two questions, if I may. One on monetary policy side and one on the banking supervision side. On the banking supervision, developing the discussion about measurement and evaluation of risks, it's always seemed to me, and maybe I'm just confused, but it's always seemed to me that there's quite a big difficulty, a sort of a step jump in modeling risks of climate change because of the difficulty in validating, back-testing. Other risks, they come and go, and so you can look over a period of time, and the bank can say, well, look, if we had used this model, it would have worked quite well. But with climate change, we know that, yes, things are happening already, absolutely clearly, but we also know that it's going to get worse, and it's going to get worse in a non-linear way, and there's modeling of the future based on scientific knowledge, but there's not the same kind of historical experience, and so it makes it quite difficult. Am I right in saying this is a real challenge for banks, and also for the supervisor, in that a bank that may be wanting to downplay climate risks would say to the supervisor, we have our models, and you can't disprove the models. So that's my banking supervision question. The question then on monetary policy. I think I've been listening to you. I think the message was mainly for people who think that stick with inflation. What are you doing about it? Why are you getting interested in climate? And your message was more to those people, yes, we need to. And I am fully, obviously, you're absolutely right on that. But is there also another type of pressure from different sources, from climate change, the radical activists, who would say, look, you're the central bank, you've got all the money. Why aren't you pushing, you talk about tilt, but it's very minor, why aren't you providing the bulk of the needed financing for the climate transition? And what's the best answer to that? Is that a pressure that's coming? And are there good answers that you can roll out?
Thank you. Thank you so much. I think these are very thoughtful questions that that are truly challenging. I think you really highlight two very important aspects. So in terms of climate change, indeed, had we gone through, I don't know, over millions of years, so some of these things already as a modern society, we would have probably, data that would help us here, but we don't. So we need to bring in forward-looking risk management techniques to an extent that, many of the more traditional risks maybe did not need to do. So the NGFS has been working on what we now call an international public good, which are generally referred to as the NGFS scenarios, which are being used by supervisors around the world, but also by banks to do that, to try to stress test. We did a first, so admittedly a first bottom-up climate stress test as an ECB last year. We labeled it for the very reason that you mentioned, as a learning exercise. So we needed to learn, how do you do this? Banks needed to learn how to do this, and this will progress in the years to come. So many, I think there is now, maybe 24 or so supervisors around the world that have done one or the other form of a scenario analysis, stress test, etc. So this in the climate sphere. So this is happening. We are sharing the insights. We are building on these NGFS scenarios. I think we now are have progressed to the 3.0 version. We will have a 4.0 version, etc. So this will develop. We will get better at this, more granular, better data, etc. But it is true, this non-linearity, these tipping points, that, and this is the scary part of this whole story, that maybe some of those tipping points might have been passed already, although maybe the really bad consequences of that we will only see later. But it might, so that's also why there's so much urgency with this whole issue more generally. If you allow me to make just that one point. So yes, this is challenging. We need to get better at forward-looking risk management techniques. Of course, we have been using stress tests as a technique more generally already for quite some time. So I'm not pessimistic. And maybe to also say that some of the stuff that needs to be done by banks is much more down to earth. So we ask, for example, so when you grant a loan today, do you actually take climate considerations into account? And then there's a surprising number of banks that still don't do that, or only to a relatively small extent, or only do this for some of their products and not for the others, and then are still in the business of of rolling this out throughout all their suites of products. So there are some of these very deep academic challenges on the one hand, and there's also just down to earth homework that needs to be done. That we quite relentlessly pressure for. That is an attempt to answering your first question. The second question, yes, we are actually we have at the ECB we have a regular a dialogue more generally with society, but also specifically reach out to NGOs on climate issues. There I would give the same kind of speech. This speech is to everyone. We need to stick to our mandate. The best that we can do is to deliver on price stability. We can only deliver on price stability if we take this into account. This has been my theme today. But if we overstep that, first of all, Frank Elderson, the lawyer, would say it's just beyond our mandate, so we cannot do this. But it would also immediately have a backlash. In many countries, not just in this one, certainly also in this one, but in many other countries as well. In the EU, we would certainly be sued and we would lose. So we shouldn't do too little. There's also legal risk in that, by the way. But we should also not do too much in terms of. Now, how do you convince people? I think, but this is very down to earth. But in my conversations with NGOs, I establish my credentials as a human being that I'm deeply concerned about these issues. So I try to always, with whomever I speak, is to and then say, but there's one thing that as a human being, the concerns that I have, on the one hand, and the other thing is what I can contribute in my position, which is indeed, a special one in terms of straddling these various mandates. But there's a limit to what we can do. But that doesn't mean that others should not also play their part. So I try to depict the roles that the various actors have. I thank them for putting pressure on us because that keeps us on our toes intellectually. And I'm always completely convincing. I'm afraid not. So any suggestions how to do this better are welcome. But in the end, I think what is convincing is one is authentic in one's concerns on the one hand, but also authentic and consistent in what you say to different audiences. And I think that in the end is my compass.
Thank you very much. I would like to ask, could you...
Please introduce yourself.
Thank you very much for your speech. I would like to ask if you find tensions among the approach you presented and market neutrality.
And sorry?
Market neutrality.
Yes.
And how can these be mitigated? Thank you very much.
Right. Well, this is also a very good question. A lot has been made, and let me just focus now on the ECB context, which of course I know best, about the market neutrality principle. I said earlier, I'm a lawyer by training, so I actually went through the treaty to try to find the market neutrality principle. It's not there. What it says is that we should contribute to to an efficient allocation of resources, etc. So it's more general, and the question then becomes whether this more self-imposed principle does not somehow perpetuate a bias that is in the market that in the end, and that was the argument I was trying to make in the speech, leads to our balance sheet not being as resilient to the economic shocks that come with climate change as we would like it to be, in order to make sure that we are best placed to also in the future be effective in our monetary policy. So I don't think that a market that is skewed as we speak in a non-Paris aligned manner is particularly helpful to stick to for 100%. I think it's much better to manage the climate-related risks also in terms of our balance sheet, so that we are fit for action in the years to come and as resilient as possible to shocks. Yeah. Now that you mentioned, you're from the IMF, aren't you? There's one thing I want to celebrate, if you allow me. I always try to picture in the end how this whole system that we have built works. And if you think about a bank with all its ties with its clients, you could, and of course people trained in finance will recognize this, to a certain extent, of course, that bank via its relationship with its clients, via its lending policies, has leverage on these clients. Now we, as I think I have made pretty clear in my speech, we have leverage, we as supervisors have leverage on the banks. So that's double leverage. And these clients altogether are the real economy, aren't they? Now the IMF, to a certain extent, has triple leverage. By going around the world in your surveillance, in your financial stability, your FSAPs, and other tools that you use in order to make sure that supervisors supervise climate-related and environmental risk in a way that is sound, and here you have your triple leverage. And I understood that in your FSAP methodology you have now incorporated the Basel principles for the sound managing of climate-related risk. that I was referring to, the work that the Basel Committee has published last June under Pillar 2. So there's a very nice and I think effective dovetailing of the work that's being done in Basel, where, as I said, also the Basel Committee is very actively monitoring progress. But here, I think we can go around the world, if you like, almost hand in hand, by you using that as well, and us learning from your experiences as well. So I just wanted to highlight that, which I thought was a very neat feature.
I have an additional question to picking up on what Patrick Honohan asked about modeling. Part of this is hard science, right? It's climate science, it's earth science. So does the ECB has the right skill set to meet the challenges that you talked to us about? Are you recruiting climate scientists? Can you give us a little bit more about the kind of data-driven and science-driven part of that action?
Super interesting and important question. To just, before I start digressing, as I sometimes do, to just answer directly, we have hired, I think as the first central bank in the world, a pure climate scientist in the recent past.
Okay, this was not staged.
And no, it was not staged. And he is part of our Climate Change Center, which is actually a pretty small group. With most of the people who work there, so I think it's about maybe 9 or 10 people, most of them, I think except for 3 or so, but are seconded from other parts of the, both the supervisory and the monetary policy, but also statistics. And, of course, we look at our entire organization with our climate strategy. Why am I putting some emphasis on this? Because you need to strike a fine balance between, on the one hand, avoiding that if you make in any organization, so this is true in the ECB, but it's also true in any other supervisory authority, but also in banks or in real economy firms. If you have your climate department, the great risk is that everyone else thinks this is something for them, not for me. And this is not the way we are going to be able to deal with this on a worldwide scale in terms of dealing with the climate crisis, but now that, talking within our own mandate to make sure that a bank manages all its climate-related risks in order to make sure that the central bank in all its manifestations, all its actions translates what this means. So in the ECB, if people ask, but do you have sufficient FTE for all this? The answer needs to be not we had 4,000 or whatever it is FTE, and now we build 10 additional FTE or 2 or 3 in the Climate Change Center, and that's it. No, all these 4,000 need to be set free within our strategy to translate as no one else can, because they are the professionals, they know their trade, whatever they do. So of course in economic research, and of course in the people that think about monetary policy, but also in the legal department. And also, also all this work needs to be audited. And in HR, we need to think about whom we, and not just climate scientists, but you also want economists that have read a little bit about this, and maybe a little bit more than just a little bit. So everyone needs to be empowered to, within a broader strategy that you set as a board. And again, this is also true for the IMF. I think this is true for everyone. That strategy needs to be set, of course, with the input of the various manifestations of the organization, but in the end by the top management, by the board. But then everyone needs to be allowed, invited, applauded for translating that in their everyday work. And that's the only way we can do this, and this is also what banks need to do.
Again, I think you gave us a very concrete example of what it means to be in an organization that is both a central bank, a monetary policy authority, but also a banking supervisor. And I should have said at the beginning that you trained as a lawyer, but you convinced us of that. Thank you so much, Frank, for an illuminating presentation of what the ECB can do, as Mario Draghi famously said, within its mandate. And we very much look forward to having you again here at the Peterson Institute and your colleagues on these and related issues. Thank you very much.
Thank you very much. My pleasure.